Hi, we will present about the prediction on interest rate. For the introduction, our project aims to predict the direction of interest rates based on a comprehensive examination of historical data, current economic indicators, and potential policy shifts by utilizing AI Assistant to compare the economic conditions and monetary policy strategies of South Korea and the United States. We can identify key drivers that may influence future interest rate movements. Such forecasting is not only vital for policymakers in formulating appropriate monetary responses, but also for investors and businesses in making strategic financial decisions.
First, we would like to talk about determinants of interest rates. Interest rates are determined by various factors, primarily the supply and demand for credit. Higher demand for money increases rates, while higher supply decreases them. For example, more bank deposits increase credit supply, lowering rates, and deferred loan repayments reduce credit supply, raising rates. Inflation also impacts rates. That higher inflation leads to higher rates as lenders seek compensation for the decreased purchasing power. Government policies, particularly those of the U.S. Federal Reserve, play a significant role. The Fed influences rates through the federal funds rates and open market transactions, buying securities to inject money and lower rates, or selling to withdraw money and raise rates. Next, we can move on to the significance of interest rates in the economy. Interest rates affect saving and investment decisions. According to Fisher's theory, individuals choose between the current and future consumption. Higher rates encourage saving by increasing the opportunity cost of spending now. For borrowers, higher rates mean higher borrowing costs, reducing investment demand. The equilibrium interest rate balances saving and investment demand, efficiently allocating resources. Next, I would like to talk about the factors affecting interest rates. Fiscal deficits and government's borrowing significantly impact interest rates. Higher fiscal deficits increase government's borrowing, raising demand for money and driving up rates. This is reflected in bond markets with higher yields. Global interest rates and foreign exchange rates also affect domestic rates. To attract global investors, domestic rates must be competitive. Central banks, like the Reserve Bank of India, adjust rates to manage capital flows and stabilize the exchange rate. The RBI's monetary policy is crucial for economic stability, addressing inflation during booms, and stimulating demand during downturns. Next, I would like to talk about the theoretical models for interest rates forecasting. In the study of theoretical models for interest rate forecasting in the US and Korea, they used a combination of machine learning models. The first one was principal component analysis, which is PCA, and it is usually used to simplify large data sets by reducing while retaining critical information. It makes the data more manageable for modeling and helps in identifying the most significant factors affecting interest rates. And in practical applications, we can use PCA to pre-process data before feeding it into more complex models. The next model they used was Bayesian recurrent neural networks, which is RNNs. RNNs are utilized to forecast interest rates by learning from historical data patterns. They are particularly effective for short-term forecasting due to their ability to capture temporal dependencies in sequential data. In practical applications, RNNs can be applied to financial time series data, such as interest rates, to predict future trends based on past behavior. And the third and fourth models they used was long short-term memory, which is LSTM, and gated recurrent units, which is GRUs. These models are suitable for capturing long-term dependencies in data, making them ideal for long-term interest rates forecasting. They can be used to forecast interest rates over several years in practical situations. The fourth model they used was support vector regressions, which is SVR. SVR is employed to predict interest rates based on historical data and economic indicators. In practice, SVR can be used to refine predictions made by deep learning models, ensuring that the final forecasts are robust and reliable. The second literature that I used to look at some theoretical models for forecasting was AI-based model for forecasting US inflation, which is Hemisphere Neural Network, HNN. The HNN model demonstrates the potential of deep learning to produce economically interpretable forecasts, overcoming some limitations of traditional models. By focusing on more sensitive economic indicators, HNN offers a more accurate assessment of inflationary pressures and economic lag. In practical application, HNN can be used to forecast inflation rates more accurately. Now we should analyze current state of interest rate in United States of America and South Korea. Focusing on the determination of interest rates like inflation and government's policy, we will analyze the current state of interest rates in the US with the Treasury yield and Federal Reserve interest rate. In the case of the South Korea, we should consider the Bank of Korea base rate and we should consider also South Korea Treasury bond. Interest rate in the US. Treasury yield is one of the determination of interest rates affected by the government. It is the interest rate that the US government pays to borrow money for varying periods of time, which means the effective annual interest rate that the US government pays on one of its debt obligations expressed as a percentage. As shown in the figure provided by Statista 2024, it is remarkable to point out 2-year, 5-year, and 10-year bond maturity. Regardless of the bond maturity, it seems that the Treasury yield is increasing from 2021. This implies that the US government pays to borrow more money to investors, which is the increase in interest rate. Also, the more high bond maturity is, the more increased Treasury yield is. Therefore, according to the Treasury yield since 2021, interest rate seems to be on the increase with the aftermath of lockdown in response to COVID-19. Next is about federal funds rate. The federal funds rate is the interest rate at which depository institutions such as banks and credit unions lend reserve balances to other depository institutions overnight on an uncollateralized basis. Institutions with surplus balances in their accounts lend those balances to institutions in need of larger balances. The federal funds rate is central to the conduct of monetary policy in the United States as it influences a wide range of market interests. And it can be divided into effective federal funds rate and federal funds target range. First, the effective federal funds rate is calculated as a volume weighted median of overnight federal funds transactions reported in the April 24/20 report of selected money market rates. Second, the federal funds target range is determined by a meeting of the members of the Federal Open Market Committee, which occurs 8 times a year about 7 weeks apart. The Federal Reserve adjusts its set interest rate, mainly the interest on reserve balances, to bring the effective rate into the target range. The target range is chosen to influence market interest rates generally and in turn ultimately the level of activity, employment, and inflation in the US economy. In this way, the federal funds rate is one of the primary tools to maintain strong employment rates, stable prices, and reasonable interest rates. It is determined by the Federal Reserve and set 8 times a year, although it can be adjusted through immediate emergency bidding during times of crisis. Since the Federal Reserve does not have direct control over interest rates, it sets the target rate rather than the actual interest rate. Once the target rate is set, the Federal Reserve engages in open market operations to hit that target. According to monthly federal funds effective rate in the United States from July 1954 to May 2024, the transition of federal funds effective rate is similar to the Treasury yield curve. Also, this figure is U.S. Treasury interest rates compared with federal funds rate. The federal funds rate pushes up shorter-term pressures to cause an inverted yield curve when the Federal Reserve wants to tame demand and inflation. The inflation rate in the United States decreased notably between June 2022 and April 2024. The peak inflation rate was recorded in June 2022 at 9.1%. In August 2023, the Federal Reserve interest rate reached its highest value in the observed period at 5.133%. The rate remained unchanged until April 2024. The Federal Reserve had commenced a series of frequent rate increases at the beginning of 2022, with the increase in August marking the 18th consecutive rise. As shown in the figure, we can see the situation that the Federal Reserve interest rates follow changes in inflation rate. If the inflation rate is increased, the Federal Reserve interest rate will increase over time intervals. Also, the shift in the Federal Reserve interest rate can be affected by the changes in the inflation rate, since we can see the situation that when the rate of change in inflation decreases, the Federal Reserve interest rate also decreases at a similar shift. Next is about the current interest rate in South Korea. First of all, we should consider the Bank of Korea law. The Bank of Korea can adopt inflation targeting as the monetary policy regime. This is the monetary policy framework focusing on inflation itself as the ultimate goal and aiming to achieve its goal over the midterm horizon instead of setting intermediate targets such as money supply. Based on Article 6, clause of the Bank of Korea Act, the Bank of Korea sets the inflation target in consultation with the government. The inflation target for 2019 onwards has been set at 2% as measured by the year-on-year change in the Consumer Price Index (CPI). The bank will conduct its monetary policy with the aim at keeping CPI inflation at 2% over the medium term, while considering symmetrically the risk of inflation remaining persistently above or below the target. As shown in the figure provided by the Bank of Korea, the inflation target is set by following the CPI. Now, next is about the Bank of Korea base rate. The Bank of Korea base rate is the reference policy rate applied in transactions between the Bank of Korea and financial institutions such as repurchase agreements and the bank's liquidity adjustment deposits and loans. It is called the base rate for short. The Monetary Policy Board of the Bank of Korea meets 8 times per year to determine the base rate, taking into overall consideration the price movements, domestic and overseas economic and financial market conditions, and so on. The base rate has a prompt impact on the core rate, and this leads to changes in short and long-term market rates and deposit and loan rates, as a result ultimately influencing activities in the real economy. As shown in the figure, the Bank of Korea froze the interest rate at 3.5% per annum after increasing the interest rate by 3% from August in 2021 to January in 2023. While the Bank of Korea formalized the termination of the increase in interest rate, there remains prudence about switching the monetary policies such as interest rate cuts. Because of both domestic and foreign prices, the Bank of Korea froze its base rate. After CPI peaked at 6.3% in July 2022, it briefly dropped to 2.8% in January in 2024, before rising again to 3.1% in February and March, when prices of agricultural goods such as vegetables and international oil prices rose sharply. This current state of CPI is more than 1 percentage point higher than the Bank of Korea's inflation target 2%. Also, according to the Hangare, it mentioned that another variable is that the Federal Reserve in the US is becoming prudent about cutting interest rates because the US is also delaying the timing of interest rate cut due to higher than expected inflation. Next is about Korean government's treasury bond. Like the US government bonds, Korean government bonds have similar characteristics. Interest rates vary depending on bond maturity, and the pattern of interest rate over time is similar to that of the US. However, it can be found that the interest rate of Korean government bonds is usually lower than that of US government bonds. In other words, it means that US government bonds are considered more valuable.
Now, we would like to move on to forecasting the US and Korea's interest rate. We would like to divide our prediction in two ways, which are short term and long term. In our short term forecast for the US interest rate, we anticipate the Federal Reserve policymakers will maintain the federal funds rate within the range of 5.25% to 5.5%. This stance reflects the central bank's ongoing efforts to manage economic conditions amid a post pandemic recovery. The interest rate, in fact, reached its highest value of 5.33%. These statistics surpassed the initial projections. While the Fed aimed to gradually reduce the interest rate to approximately 4.75% by the end of 2024, achieving this target seems highly impossible at the moment. And now I will move on to explaining the reasons. The Fed's decision to sustain a high interest rate about 5.5% was to combat inflation that has emerged as a significant concern following the COVID-19 pandemic. According to the Board of Governors of the Federal Reserve System, the inflation rate is around 3.4%, far above the objection of 2%. If the inflation rate remains stubbornly above Fed's targeted level, policymakers will opt to continue raising interest rate as a means to curb excessive demand and reduce the inflationary pressures. This strategic move is aimed at maintaining overall economic stability. Furthermore, the low unemployment rate also signs that the interest rate will not decrease in 2024. The tightened labor market will also lead to an elevated inflation rate, and thus the Fed may be reluctant to cut interest rates. One of the methods the policymakers may utilize is an AI model called HNN, a Hemisphere Neural Network. Mentioned beforehand, Hemisphere Neural Network succeeded in explaining the inflation surge in 2023 and the beginning of 2022. Other AI models were not able to anticipate such surge. However, through leveraging sensitive indicators, HNN successfully estimated the future rate. Inflation rates are the key inputs into forecasting the interest rates. They tend to move in the same direction as central banks adjust interest rates to manage inflation. To forecast the near future interest rate of the United States, this AI model will be beneficial. Now, in the long term, the interest rate will eventually decrease to the targeted level. The most important thing is that the policymakers and the Fed should balance inflation and interest rate. This is a paramount decision, for it may lead to widening the wealth gap, just like what happened during the COVID pandemic. Furthermore, according to the economic cycle pattern or the business cycle, the economy tends to experience the altering periods of contraction and extraction. In other words, economic downturns are followed by economic upturns. Currently, the US economy finds itself in the expansionary phase of the business cycle. This can be evidenced by several key indicators such as sustained GDP growth and robust labor market. The cyclical nature of the economy suggests that an economic downturn or recession is likely to occur in the future. During the periods of recession, the Federal Reserve will respond by lowering interest rates. On June 12, 2024, there will be another conference of the FOMC announcing their future plans on interest rates. We strongly believe that they will not decrease the interest rate, but rather maintain the current rate around 5.25% to 5.5%. Actually, we are filming this video on June 13th, and our predictions were right. Now let's move on to forecasting the interest rate of Korea. It is imperative to underscore our emphasis on delineating the correlation between the US interest rate and that of Korea. Theoretically, elevated interest rates tend to attract foreign investment, consequently increasing the value of the country's currency and vice versa. Korea's interest rate, hence, will be affected by the US interest rate. Currently, the Bank of Korea froze the interest rate at 3.5% per annum from January 2023. This rate freeze was prompted by persistent inflationary pressures observed from 2021. While some forecasts suggest that the key rate is expected to cut twice to 3%, it seems that this appears unlikely. Our assertion is that Korea's interest rate will either remain 3.5% or may even decrease in the short run, or maybe increase in the short run. There are two primary reasons. Firstly, Korea's annual inflation rate is steady at 3.1%, while the targeted inflation rate is 2%. To effectively manage inflation, it will be compulsory to uphold the current level of interest rate. Secondly, as previously mentioned, Korea's interest rate is influenced by the fluctuations of the US interest rate. With the United States interest rate steadily remaining at 5.5%, it will be challenging for the Bank of Korea to lower its interest rate. Such a move could precipitate a decline in the value of Korean currency. An alternative approach for forecasting the interest rate of Korea involves employing the principal component analysis or PCA method. According to Amazon AWS, deep learning is a method of teaching artificial intelligence to process data in a way that is inspired by human brain. And using this AI models, researchers will be able to predict Korea's interest rate according to the US interest rate data. In the long run, or the long term, our forecast suggests that the interest rate of Korea is likely to fall, influenced by the trajectory of the US interest rates. Given the interconnectedness of global finance markets and the prominent role of the US economy, changes in US interest rates can have far-reaching effect on interest rates on that of Korea. The primary consideration now lies in determining the extent to which the interest rate will decrease.
Now we will present about the limitations and challenges in economic forecasting and modeling. For the uncertainties, economic volatility presents a significant challenge in forecasting and modeling. Global economic shocks such as financial crisis, commodity price fluctuations, or significant economic downturns in major economies can drastically affect interest rates. These events introduce a level of unpredictability that complicates accurate economic forecasting. Additionally, domestic economic performance is another critical factor. Unexpected changes in GDP growth, unemployment rates, or consumer spending can influence central bank decisions, making it difficult to maintain stable economic projections. Political policy and instability also contributes to uncertainties in economic forecasting. Political changes, including elections, shift in government policies, or political instability can create significant uncertainty regarding future economic policy directions. Third, technological and structural changes introduce another layer of complexity. Rapid technological advancements can alter economic productivity and inflation rates, impacting interest rate decisions. Similarly, structural economic shifts, such as changes in industry composition, labor markets, or demographic trends, can introduce uncertainties in economic forecasting. Global market conditions play a crucial role in shaping economic forecasts. Interest rate changes in other major economies, such as those made by European Central Bank or the Bank of Japan, can influence global financial conditions and impact interest rates in countries like South Korea and United States. Furthermore, currency fluctuations can affect trade balances and inflation, thereby influencing interest rates and economic stability. For the limitations, forecasting models often operate under certain assumptions that they may not fully capture the complexities of real-world economies. Simplified representations can overlook important nuances, while the challenges of accurately estimating model parameters mean that small errors can lead to significant deviation in forecasts. Second, data quality and availability are also critical limitations in forecasting. Reliable and timely data are crucial for accurate forecasting, but inaccuracies or outdated information can lead to incorrect predictions. Additionally, limited historical data, particularly for new economic conditions or policy impacts, can hinder the ability to provide reliable forecasts. Unpredictable external events further complicate forecasting. Natural disasters such as earthquakes, pandemics, or other catastrophic events can have significant and unpredictable economic impacts. Similarly, behavioral factors also play a crucial role in the limitation of economic forecasting. Changes in consumer confidence or investor sentiment can significantly influence economic outcomes, yet these factors are often difficult to predict with traditional economic models. Market psychology, driven by investor behavior and herd mentality, can lead to unpredictable market movements and interest rate changes. Finally, the effectiveness and timing of policy measures introduce additional uncertainties. The speed and impact of monetary policy transmission can vary, making it challenging to predict the timing and magnitude of interest rate effects. Moreover, central banks' ability to influence the economy may be limited by external factors or diminishing returns from traditional policy tools, adding another layer of complexity to economic forecasting. Next, for the limitations for theoretical models. PCA is a powerful tool but comes with its own set of limitations. First, it has linear relationships between variables, which restricts its effectiveness in capturing complex nonlinear patterns in the data. Second, interpretability. The principal components derived from PCA are linear combinations of the original variables, making interpretation challenging, especially when dealing a large number of variables. PCA's sensitivity to the scaling of data means that variables with larger scales can dominate the principal components, necessitating careful processing and normalization. Furthermore, PCA focuses on maximizing variance, which might not always correspond to the most important features for a specific task, potentially overlooking critical aspects of the data. Lastly, PCA can be sensitive to the noise in data, which cannot distort the principal components and reduce the quality of the result. RNNs also face significant challenges. They suffer from vanishing and exploding gradient problems, which make training difficult for long sequences as they become extremely small or large. Basic RNNs struggle to retain information over long sequences, limiting their ability to model long-term dependencies effectively. Training RNNs can be computationally expensive and time-consuming, especially for large datasets or long sequences. Third, LSTM networks, while addressing some limitations of basic RNNs, comes with their own set of challenges. LSTMs are more computationally intensive due to their complex architecture, which includes additional gates and memory cells. They can also overfit to training data, especially with small datasets or insufficient regularization techniques. LSTMs typically require longer training times compared to simpler models, which can be a limitation for real-time applications. Furthermore, LSTMs have hyperparameters that need careful tuning, such as the number of layers, hidden units, and dropout rates, making model optimization challenging. Finally, GRUs are simpler than LSTMs but still have higher computational complexity compared to basic RNNs due to their gating mechanism. Like LSTMs, GRUs can use overfit to training data if not properly regularized, requiring careful things of regularization techniques. GRUs have hyperparameters that need tuning, and finding the optimal configuration can be time-consuming and computationally expensive. Training GRUs can be resource-intensive, requiring significant computational power and memory, particularly for large datasets. For the conclusion, as of mid-2024, South Korea and US are navigating unique economic challenges affecting their interest rates. The US Federal Reserve is managing persistent inflation with cautious rate adjustments, while South Korea's central bank adopts a more accommodative stance to stimulate growth. The interplay between these policies highlight the complexities of global economic integration, crucial for policymakers, investors, and businesses in today's interconnected world.
This is the end of our presentation. Thank you for listening.